Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and I want to talk about what's going on in the financial markets for a few minutes with you today. Um, Tomorrow is the Federal Reserve meeting. The Dow, as I'm speaking, as we're going into the final 30 minutes of the trading session this Tuesday, is down 400 points. The most significant thing, though, is that the yield on the 2-year Treasury bond is hitting a 15-year high. If we look at the TLT exchange traded fund that tracks the 20-year Treasury bond, as you can see, it's trading at a new low for the year. The LQD ETF, which tracks investment grade corporate bonds, so the best, safest, largest corporations in the United States, it's at a new 52-week low too. The bond market in the United States and really across the world is in a bear market. And the bear market in bonds began before the bear market in stocks happened this year, which really started around New Year's. The bond market actually peaked out months before that New Year's rollover in the stock market. So you could say that bonds are dragging the stock market down, and the value of bonds trades opposite to their yields. So as interest rates go up, bonds go down, and the Federal Reserve is now on track to raise interest rates through the end of this year and into next year. The Fed fund futures market is now pricing in rate hikes up to 4.5%. And this current rate hiking cycle coming to an end sometime, in the first quarter or the spring of next year. So this is a negative backdrop, macro environment for the stock market. And it's very difficult to do much in this market. Um, the thing is, look, when you have a Fed meeting, which is what we got tomorrow, when the market falls into the meeting, it does tend to rally once the meeting happens for a few hours, sometimes a day or two. And opposite, when the market rallies into a meeting, it often sells the news. Buy the rumor, sell the news. It's sort of the opposite: sell the fear and buy when the fear happens. But that's a trader's trend or a day trader's trend, and if the market does rally, I mean, it could just be for 15 minutes. So personally, I don't do that kind of trading, and I would see such a move as just a temporary gyration. We're trading below the 200-day moving average on the S&P 500, and that's my definition of a bear market when that happens, and you're in that area is acting as resistance. And these type of declines typically end when there's a panic washout. We haven't seen that. So this is my way of telling you that personally, I'm not looking to really try to do any buying in this market until there's a panic washout or we really get to the end of this interest rate hiking cycle for real. And I'm not just saying, some person on television or a guru somewhere is saying, "Oh, the Fed's going to pivot." Well, yeah, when they were saying that 4 months ago, and they've been wrong. One day they will, but and we don't even know what that pivot means. Does that mean they're really going to lower rates, or just pause and not raise rates for quite some time? Because that's what they've been saying that they want to do. That they want to get the rates up now to over 4%, and then pause and hopefully not after lower rates. That's their plan. So what I want to show you though is how individual stocks and sectors, what have they been doing in regards to the trading in the stock market. So what I'm gonna do is load up this software. It's called TC2000. I use it to see what's going on inside the stock market beyond the averages. beyond, looking at an app or the TV and seeing the Dow's up or down. That doesn't really mean anything. Because when you're in a bullish situation, you see more stocks go up than down. And when you get near an important bottom, you'll start to see less stocks have significant declines. And if you're really about to have a constructive rally, you see a lot of constructed bases in stocks. So I did an update about the market like this 7 or 8 days ago, and the market had an up day, and there's some excitement. But I looked inside here, and I couldn't really find constructive individual stock patterns, and showed that. So what you're looking at here is I've ranked all stocks since the June low in the S&P 500, and this is the worst performing stock in the S&P 500. Western Digital, Baker Hughes, Match.com, Celanese, Generic Holdings, Newmont, interestingly, Halliburton, Adobe, Dow, Intel is on the list, Freeport McMoRan, NVIDIA is on the list. NVIDIA being one of the most, that's WestRock company. Here's NVIDIA. NVIDIA being one of the most popular stocks to own, often the #1 most stocked every single day among Fidelity account holders, is one of the worst performing stocks since the June low. There's absolutely no reason to try to buy the stock, guess a bottom if you want to play a rally. If you want to play a rally, and I don't think it's worth playing, but if I wanted to, I'd be looking for stocks outperforming the market, not lagging the market. Stocks that lag tend to fall more when the market declines and then go up less when the market rallies. They're dead money situations. And so many popular stocks that people own are in that category. Advanced Micro, Micron, is it Facebook made a new 52-week low yesterday. So a lot of the semiconductor stocks are in this category. International Flowers, Dish Network, Applied Materials, another semiconductor stock. So semiconductor stocks, that's a sector to really avoid in this market. 3M doing terrible. CarMax doing terrible. It's making new 52-week low today. Diamondback Energy, Tyson Foods. So what's doing good in the market? Okay, let's take a look. Inside the S&P 500, Tesla is outperforming. Etsy is now outperforming, although it's done terrible since January. So I wouldn't get excited about that. Starbucks is outperforming. NASDAQ. So, I mean, if you want to do a pair trade, that's where you short a stock and buy a stock, shorting, let's say, NVIDIA and going long Facebook, or going long Tesla, not Facebook, but shorting NVIDIA, going long Tesla. That'd be a pair trade. I don't really, you're better off doing that in different sectors. That's a more meaningful pair trade. Charles Schwab outperforming the market. Now, this is a stock that I would say has a potentially constructive base. It's going sideways, and if the market were to have a panic washout, this would be the kind of stock I'd look to buy for a potential breakout of its recent highs and then a rally up. But the market's not in that sort of position. So many of these stocks that are out at the top of the outperformance list in the S&P 500 are trading below their 200-day moving average. Some of them are just terrible laggards. This is another one that is more constructive. Global Life, I would say. It's above the 200-day moving average. It's in a sideways overall pattern. Apple's more constructive. VICI Properties, one of the best performers too. That's a REIT, actually, that owns casino properties. PayPal. See, this is an example of one of the stocks that's been outperforming since June, but it's been, it just looks like a dead cat bounce because it's been falling so much all year. How about sectors? Well, one of the neat things TC2000 does is it breaks the entire stock market up into 238 sectors. They call them category groups. And if we do that, the top performing sector is dairy products. Next is sporting goods stores, generic drugs, music video stores, which looks terrible. That looks like a likely dead cat bounce. So does this. Eateries, info. We talk about like an eatery stock. This was really, going to get bullish, and it could. What I look for this sector to do is we've had this rally. I'd look for it to go sideways and form a base as the stock market rally fails and we make new lows and have another leg down. If this sector can go sideways while that happens, this could become one of the best sectors next year. So that's the kind of thing that is, and so this auto manufacturers, wholesale drugs. So I see sectors that I'm not excited about. Not this is another one, educational training companies, that I'm not excited about buying now, but they could become bull. They could do well next year if it can continue to outperform the market and build a base. So even though I'm telling you, regional banks is another one, oil and gas drilling, long-term care facilities, recreational vehicles, so restaurants. So look, I'm telling you, I don't really see any reason to get excited to try to buy stocks, try to buy a rally. We're in a bear market. There's no sign that we've had a panic washout. Go ahead, day trade if you want. I'm not that kind of person. I want to buy sectors and stocks I think I can hold for at least 6 months, hopefully much longer than that. But I'm more of a position trader. And for that, I want to be patient. I want the things to line up for me when it comes to stock market with a good buy point that I really can believe will lead to a good rally and buy the best performing stocks and sectors in a good position when that happens. Good chart position and hopefully, good earnings outlook too. So those are my thoughts on where we are, what's happening inside the stock market as we look at things now. So look, if you want more videos and analysis like this, hit the like button. As you're new to my videos and you want to get the next one, hit the subscribe button, hit the bell next to it, and YouTube will send you an alert as soon as it's up and for you to watch.